Hey, everybody, and welcome to the My Father Said podcast, where we talk all things faith, finance, and family. I'm one of your hosts, Ryan. I'm both a father and a son.
And hey, everyone, I'm Robert. I am Ryan's father, and I am my father's son as well. We welcome you to today's podcast.
We're so happy you're with us today. Today, we wanted to talk to you guys about year-end tax avoidance strategies rather than tax evasion, because one of those is illegal, correct?
We can't evade taxes?
I think that's what they got Al Pacino on, right?
Al Pacino? I know we got Al Capone.
Yeah, as I was saying that, I was like, all right, don't say Al Pacino. Don't say Al Pacino.
Yeah, I know Al Capone was, I already got him for that.
Al Pacino.
I didn't know Al Pacino. If you're out there listening.
Sorry, I'm not trying to put you in prison.
We don't want you to come after us for defamation of character or anything like that.
So, before we get into today's topic, what have you been up to?
Well, we just got back from New York. That was the first time ever in my life I finally bit the bullet, and your mom has always wanted to go see New York, and I figured, well, we'll see New York and Christmas lights at the same time. And hesitantly, I scheduled this thing, and I have to say it was probably one of the best trips ever. I would recommend anyone to go up there and walk Fifth Avenue, go see Rockefeller Center, go down to Times Square and Central Park, Carnegie Hall, all of the places, take on a Broadway show. It was great. It was a fantastic experience, and it's one of those places where I told your mom, I said I would come back and do this again. And to hear me say that after my preconceived notions of New York, that's a big say on my part.
What was your favorite part? What was your least favorite part?
We ate at a place called Ray's Pizza, and it was just the atmosphere. The Ray's Pizza was on, I think, 57th Street and 57th Avenue. I don't know. 7th. It was one of those places you could see
somewhere in New York.
It was somewhere in New York, but it was right on the same street that Carnegie Hall was on. Let's put it that way. But the pizza was great. The atmosphere was even better, and the line of people outside made us think maybe that pizza tastes pretty good, and that pizza tastes pretty good. So Ray's Pizza, if you're listening to this podcast, this is a free advertisement for you. When I come back, I expect a free slice of pizza for this. So I'm going to tell you, do that. Your mom, I think, really enjoyed the Broadway show. We went and took in Wicked, and I think she enjoyed that. It changed her mind a little bit about Glinda the Good Witch.
I told you that it would.
Yeah. So yeah, but it was good. It was good. It was great. I encourage anybody to go do that.
What was your least favorite part?
I can't really say I had a least favorite part. I mean, everything was good. It was a great trip all the way around.
Okay, cool. Well, with that, we'll go ahead and get into today's topics, which we already said was tax avoidance, not tax evasion. So as we approach the end of the year, there are a couple of things that you can do to help mitigate your tax liability when you go to file your taxes. The first one is probably pretty obvious. That's going to be maximizing retirement contributions. That's, contributing to traditional IRAs, 401ks, 403bs, 457s, things of that nature. The big one that we always hear about is, employer 401ks. Take it up to the match, but another benefit of getting free money is you're lowering your taxable income. So those are the big gimmies.
Yeah, you're doing a couple of things at the same time there. You are potentially reducing your taxes while simultaneously at the same time setting money aside for your retirement. So you're getting a twofer, which is great. Now, I will say one thing about the program today that we want to make sure our listeners understand. We do not give tax advice. We do not do that. That is not our specialty. We will also tell you that we tell our clients in the world of finance, your best ally, in addition to someone like Ryan and myself, your best ally is going to be a competent certified public accountant. If you are investing money and you are planning for your future, it is very wise to walk hand in hand with not only a financial advisor such as ourselves, but also with a certified public accountant. Those individuals can make your life very, very, very good moving forward versus trying to go out and figure this thing out on your own.
Al Capone probably did not use a CPA.
I don't think Al Capone did. Al Pacino probably
might use a CPA,
yeah.
Yep.
Yeah, but I don't think Al Capone did. Another area that I would say that you could look at is one a lot of people don't really grasp. It's you harvest tax, or I should say harvest investment losses. You know, throughout the year, some of your investments might be upside down. Mm-hmm. And you might actually have taxable gains on one side of the scale, and you're trying to offset these things, and you're looking for a reason perhaps to dump an investment that has not showed you a profit. Well, at this point in time, you can get with your CPA and take a look at your portfolio, and it might be advantageous for someone to actually sell an investment that is at a loss so that you can offset a gain on your taxes.
Now that's typically in, after-tax brokerage accounts, right?
Absolutely.
Because your 401k and your IRAs and stuff, those aren't capital gains that we're going to be taxed on. Those are ordinary incomes and stuff.
Absolutely. Absolutely.
Yeah, that's another one. Another thing is taking advantage of tax credits. The big ones are the child tax credit. If you have kids here in America and you claim them on your return, that lowers your income, which is great. So any tax credits that might be available to you, we would recommend using those. And, at least just tell your CPA what's going on. They'll be able to determine whether or not, you qualify for those. But the big common ones are the child tax credit. There's certain education tax credits. And then in today's day and age, there are certain tax credits for, making your home more energy efficient and things like that. Mm-hmm. So, if you've done anything like that, college, kids, solar panels on your house, whatever it is, consult with the CPA. They'd be able to tell us, if that qualifies or not for the tax credit.
That's right. In some places in South Carolina, you can go down the highway and you can see homes without doors on them. I think a good tax credit would be put a door on your house.
Okay.
Yeah, I think so.
That just must be down in Nice's, right?
Well, it's down in the country. It's down in the country. Another thing you can do is accelerate your deductions for the year. If you are someone who itemizes on your tax return, you might want to consider accelerating deductible opportunities. Things like if you run a business or you own a business and you want to get some equipment, maybe before the year end comes, go purchase that equipment, purchase materials for your office, whatever it might be. If you want to try to get some deductible expenses taken care of prior to the end of the year, you may want to go in and purchase those things. And that for every business, it ranges from one side of the scale to the other. Again, this is something you want to speak with your CPA about and to make sure it makes sense to do it this side of the calendar versus next year.
Right.
All right. So that's always a conversation you want to involve them in.
Yeah. That goes hand in hand with like deferring income, right? Because, you can play around the line of, hey, I want to have a business expense this year versus next year. And the same thing as, hey, I want to lower my income this year, so I'm going to wait to bill, or I'm going to wait to get an income to next year, right?
Absolutely. Absolutely. You can look down the line and say, hey, I've done some work this year, but what I want to do is I don't want to add to my taxable income this year because my income at this point may be tipping the scale of going into the next tax bracket.
You're right.
Or I might already be in the next tax bracket and I don't want to pay any more tax than I necessarily have to. And if I can delay it for a month or two and go into next year, thinking that next year my income may not be as high as it was this year, then I could conceivably save some money on taxes by just deferring my income until next year.
Yeah, we love avoiding taxes here. If you can't tell, we love that. Taxation is theft. We were just talking about that a little bit ago of just how much we hate taxes. So just going to throw that out there.
Taxes has a good spot in life. I mean, without taxes, we wouldn't have roads. Okay? No, seriously, you wouldn't have roads.
America went to war because of taxes. Let's just remember to put that out there, okay?
Yeah, but taxes handled right has their appropriate place in society. Now, when you look at this government that we have today, and their pathetic record of representing we the people, then yes, I could understand why you would be highly uptight with paying taxes to a bunch of incompetent, self-serving, handout, promising everything but not getting anything back in return. Individuals such as that. To go, not to chase a rabbit, but you want to know how when a politician is lying to you?
When their mouth is open?
When their mouth is moving.
There you go.
Yeah, that's how you know.
There you go. You said that taxes have your place. If I take money from you under the fear of imprisonment or violence, you'd call that armed robbery, right?
Yes, I would.
But when the government does it, we just call it taxes.
Absolutely.
Yeah.
Absolutely.
So we don't like taxes.
Now I'm depressed.
So another way to avoid those taxes are the flexible spending accounts and health savings accounts. Individuals and employers alike have started to realize just how expensive healthcare is. Health insurance, the premiums, getting any service done, any surgeries, anything like that at all has gotten pretty expensive. And so a lot of insurance companies, a lot of employers have gotten together and made vehicles such as the HSA and the FSA, which allow you to put money away pre-tax for medical expenses. So, if you have got access to one of those, we would say take that up. I mean, you're going to have some kind of medical expense. It goes hand in hand with the emergency fund. We don't know what's coming down the road, but we know something is going to come down the road. So if you've got access to an HSA or an FSA, take that, use it. The only thing that we would caution you about is the FSA. They typically have something called a use it or lose it provision, which is if you have put money away and then you don't use it by the year end, that does not roll over. That goes away. So that's something to keep in mind. HSAs typically don't have that. You can, year over year, put money away into that.
Yep, that is true. Another one you can do that we don't want to overlook is charitable giving. If you attend church, obviously your tithes and offerings, those are tax deductible up to a limit. You get to set those aside. And then, of course, you've got your 501(c)(3)s and things of that nature where you get to set money aside in various nonprofits that you can, whatever it might be. You might be someone who cares about animals, so you want to give to that cause, or you might be someone who cares about veterans or whatever it is that that wets your whistle, I guess. You can set aside monies inside of that and get those tax deductions for that as well. 501(c)(3)s. Yeah. You can do that.
That's one of the cool things about the nonprofits is you can find something that you're passionate about to give money to fund, and at the same time get the benefit of lowering your taxes. That's the great thing. You're not pigeonholed into, hey, there's only one thing I can give money to.
Absolutely. So. But wouldn't it be great if your taxes were deductible? Yeah.
Speaking of that, did you know that you can give money to political campaigns? And those are tax deductible.
We have not a chance.
Yeah.
Not a chance.
I'm not going to give money just so you can say we need to take more of your money.
I keep getting these emails. I got one a while ago saying that Ron DeSantis has recognized me as being the number one, I won't say what party, but the number one person in the state of South Carolina.
Really?
And I thought,
that's impressive.
Ron DeSantis doesn't even know who I am.
Yeah.
And has no idea, but he knows I'm number one.
That's right. He knows you're number one.
And they send these emails out to people. And do you know there are ignorant people out there who will respond to these and say, oh my gosh, he knows me. He loves me. Let me give him money. No, don't do that. Don't do that. I mean, just don't do that. There was once in my life I thought that I wanted to grow up. I wanted to get into politics.
Really?
Yes. But the older I get, and the more I look and I see how these individuals conduct themselves and how they literally rape the American citizen, I don't want any part of them people. They disgust me. They absolutely disgust me. And now back to the program.
So another way to avoid taxes, especially here in South Carolina, I don't know what it is state specific, but here in South Carolina, is contributing to 529 plans. If you have young children or children that are approaching college, you probably know what those are. But for those of you that don't, a 529 plan is a state-ran program, I guess is the best way to say it, that allows you to put money away, and so long as the beneficiary uses that money for college expenses, it's tax free. They can pull out the growth and everything to use that for college. That's going to grow tax free. But the big benefit being here in South Carolina is what you put in. Every dollar gets put into some sort of algorithm that the state uses, and it can lower your South Carolina taxes. It doesn't affect the federal taxes, but it does affect the South Carolina taxes. Now, one thing I want to be clear about with that is it's not a dollar for dollar reduction. So it's not you put $1 in, my taxes are lower than $1. It's just a piece of every dollar you put in gets put into that algorithm. So if you've got small kids and you're looking to avoid taxes, 529s are a great way to do that.
I got you. Another thing you can do, of course, is you can consider making gifts to family members.
I would love one, Dad. I am so happy that you brought that up of all people in here.
Yeah, and I said that you can consider. Doesn't mean you have to, but this past year, the annual gift exclusion was $17,000.
You're going to give me $17,000?
I, as your dad, could give $17,000. Your mom could give $17,000.
$34,000.
So yeah, we could have done that. We're not, but we could have, and that's something that individuals, if they're wanting to reduce their taxable estates and also get a tax break while doing it, that's something they can try to do as well.
Another one is just review your tax withholding. That one's pretty simple, but if you've had any changes to just really your life, you got married, God forbid you got divorced, you had a child, you had multiple children, you switch jobs, you've got a lower income or you've got a higher income, just reviewing your tax withholding can make sure that you're not overpaying or underpaying Uncle Sam throughout the year. So that's another one, is just if anything has changed, it pays to talk to a CPA and see if you need to make any adjustments.
Absolutely. What else you got on there?
I think that's it, other than we've got qualified business income deductions. So this one is, again, we would say refer to a CPA, but this one is a little more planning and strategy wise. If you have something like an S Corp, you do not have to take the whole income as earned income. You could say, hey, I'm going to pay myself, 70% of what I make, and that's going to be taxed at the earned income level. And then I'll take, 30% and use that as a K1, an owner distribution or something like that. The reason that is beneficial is, ordinary income tax, we've got state, federal, Social Security, Medicare, employer, all of those taxes. And then if you take a owner distribution, a K1, something of that nature, that avoids Social Security, that avoids Medicare. And so, based off of what your CPA says, you could conceivably be in a lower tax bracket and still make as much money as if you would have took the 100%, as a 1099 or something like that. That is a little more specific. Again, we would say talk with your CPA about that, but that is also a way to just avoid taxes here at the end.
Yeah. So I hope today, if you're listening to this either on your automobile or if you're watching it on YouTube or something like that, I hope what you picked up today is
that we hate taxes more than anything.
Well,
who cares about the strategies? We hate taxes.
Yeah. Well, taxes are a necessary thing that needs to be implemented and operated correctly to help support the infrastructure of this great country of ours.
That sounds like a politician's answer. You sure you don't want to run for politics?
Well, I just know that, oh God, don't even get me started. Yeah, don't even get me started. I wish we could find honest, decent, God-fearing people to actually be representatives of the people instead of being expected rock stars, and they want the people groveling at their feet like people grovel at their feet. It is amazing to me to watch. It's disgusting. It's like taking a laxative and expecting something great to happen. I mean, it's just not going to happen.
Well, with that being said, before Robert's vein pops out of his head again, it was pleasure being here with you guys today. I'm one of your hosts, Ryan.
I'm Robert.
And if you want to learn more about the Templeton Group or the My Father Said podcast, feel free to check out our website and look at us or listen to us wherever you listen to podcasts.
Absolutely. You guys have a great one. My father said, get out of here.
The opinions voiced in this video are for general information only and are not specific advice or recommendations for any individual. All performance reference is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.